Hello everyone, this is Juan Sarmiento and today is Friday, April the 14th. This is the second time I do this recording. The first one failed, and the worst part is that I have already done a bunch of trades. So what I'm going to do is try to summarize what I did. First of all, the AXP here trade that I have done last week, I was trying to close this. This is my trade that would not close. I made it into a good till cancel order. This was closing 200 shares and opening a May 12 options. That did not work. Okay, as you can see, I'm selling shares here, which means that I had 200 shares positive, meaning long. And so what I decided to do instead was to exercise, you can see AXP first, to close one of the 100 shares. I'm sorry about this. One of the 100 shares, and it did fill against my existing long puts, 180 long puts. Why would I do that? Because the May 12th was not filling, and I do have the long back month options against those shares. So all I had to do was to close that, and I did. And I ended up with 100 shares. And this is the interesting thing now, because I wanted to show you that when this happens, you have the alternative to create a cover call. Because the stock has dropped so much, I gotta sign the shares, okay? Now you have 100 shares, 200 shares. Well, we can use those shares and sell calls against it because the stock has gone down, volatility is high, you sell a cover call. And so I look for the better cover call. So I say add simulated trades, and I look for a call that would be expiring close to a month. And so I found May 12 here, and I look for the options with the most extrinsic value. This is the value of an option that will simply be zero at the end of the expiration period. And I'm getting here $5.27 or $527.50 for it is what I got. Okay, so now I have a cover call. And why would I do a cover call? Well, because perhaps you can roll this over month after month after month, and every month you get about $500. Okay, presumably, if it could be something between $300 and $500, and perhaps that's if you have 10 of this, now you make $5,000 every month out of this. Of course, you're basing that on the fact that you own the stock, and that's a big chunk of money. At $160, 100 shares, that's $16,000. But you're getting a lot of money out of that. Just calculate $500 out of a $16,000 investment, and you know that you're getting quite a big chunk, about 20%. Well, calculate it. You do the calculation yourself. Okay, and so that's what I'm doing, and that's what I'm going to do from now on. Why would I do that? Because I'm a retiree. I own the stock. I don't want to sell the stock now. I just want to. I think that this is a stock that I chose because it jumped in earnings, good earnings, and then collapsed. And then when it collapsed, you might say that was an unreasonable collapse in the price of the stock. And now it's been going down a good sideways. And well, we have earnings coming up, and the volatility is going up because of that. So the only problem is, what if it continues to go down? Well, if it continues to go down, you keep on selling your calls every month. And I'm going to show you from now on how to select a good option. And on principle, you're going to select that option that is closest to the current stock price, the current stock price, and will give you the most extrinsic value, and it has slightly less than a month to expiration. Okay, so that's AXP. The other was CRM. It's still not filling. Okay, this is a trade that I put a week ago, and as you can see, is 75 cents. I'm asking 75 cents for the rollover. This will be closing today's option that expires today, and sell another option. And of course, this April option call would expire. I could get assigned the stock, and now next week we will have short stock. So I'm leaving this, and then on Monday I will deal with that, make you a little video on how to essentially close a short option position. Okay, we'll do that next week. All right, I have also a rollover on FedEx, and you can see that I'm going from April 1st, and so I did a rollover on your April 21st calls. That's next week, a week to expiration. I sold May options. On the Adobe here, I did the put side. Oh, wait a minute. I did only one put side. Well, we need to close the April puts. Okay, let's go to Adobe. You can see that I did it in two parts. Normally you can do a rollover, the two parts, the puts and the sides simultaneously, the puts and the calls. But in this case, they're far away from each other. So let's go back to Adobe. And let's see a risk graph here. Okay, and I haven't closed this April 350 put. We may as well close it now, although it's very likely to expire between now and a week from now without much glory, but we can close it paying 26 cents for it. Just in case the stock collapses. 1 week is a lot of time, and it could happen. So let's pay the 26 cents for it to close this April there. And now we have this position more orderly here. Okay, good. I need actually to correct this 26 cents. 26 cents, so it's 78.06. Okay, that's the real price of that option. All right, that's better. Okay, what else did I do? XP, FedEx, okay, Adobe, cool. All right. Okay, so the other ones, the other stocks, I either, let's say, analyze here for BP. You can see that the expiration is May 5th, plenty of time for that. FedEx, Google, April, that's next week. But as you can see, the stock is way deep in the money. Okay, it's way up here. So I don't care. The risk I'm running here is that I get assigned the short options and then end up with the short shares, 100 shares of Google. If that were to happen, then I have to get in and close that and sell some of my long calls against that. Okay, so instead of that, I can choose to do a rollover of the call and leave the put alone, because the put is likely to expire. So let's do the rollover of the call here. Analyze rolling. And I'm gonna say sell the May 19th. And I'm gonna get $2 for that, close to $2. Completely. And I'm getting $780 for that. And the put side, I'm going to leave alone. And as you can see, it opens the 19 May call. I'm going to close the April, which is 1 week to expiration. Let's go to Oracle. And here we have May 5th. I'm going to leave it alone. This one, same thing. We can do the same as we did in Oracle. Do the rollover. And we're going to sell the May 19th. Okay, confirm and send. So I'm rolling over the April 21, 1 week to expiration, all right? And it got filled right away. Good, that gives us money back. And the STX in May 12th. That's about it that I need to do. So going forward, we're gonna keep this covered call as a way to generate capital. So if a stock collapses on me, shares are assigned, you can always do what I just did. The assignment does is remove my short and the extrinsic value went to 0, so I got assigned the shares, all right? And I can sell a call against it, and that call has extrinsic value, that is value that would evaporate with time. And so that's the principle on the covered call, and we're going to cover this, deal with this covered call on AXP going forward, and I will teach you how to select the proper call for most benefit. Okay, that's about it for today. Thank you very much for joining me, and see you next time. Bye bye.